start that. Start recording. And today we have Max Boyko, who's a local Sacramento investor and lender, investor, developer. I mean, he's done a lot of things and through his career, so he'll share more about that. And I think Max, I'll just give it over to you. Let us know if how you want to do the presentation. If you want any questions that come up for people to jump in and ask right away to do it more interactive, or maybe just wait uh, for the Q&A time after. Let us know how you want to run the presentation, and we'll go from there.
I'm pretty flexible, so if anyone wants to jump in and kind of ask questions through the presentation, feel free to. Although, I kind of think some of your questions might be answered in a future kind of something I say. So maybe we just kind of, I don't have a very long presentation, but I want to cover all the main bullet points and then kind of keep it as an open mic and allow people to just ask whatever. Feel free to ask whatever you want. And if I start sneezing, excuse me, the allergies for some reason the last few days have been absolutely terrible. No matter how many pills I drink, it hasn't helped.
All right. Well, take it over then, Max. Cool. Thanks for joining us.
All right. So can everyone see the screen?
Mm-hmm. Yes, sir.
Yep.
All right, cool. So cool. I just want to start with basically a little bit of an introduction about myself, who I am, kind of what I've done. And, and the reason I do it, it's definitely not to brag, is just to kind of give you an idea of my background and, kind of the different resources that I can provide to you guys as a group, as well as just you as investors or individuals, that kind of need a support or have any questions or, kind of want to dive deeper into any topics. So basically in my career, I started in 2006, basically started as a loan broker doing conventional loans. If 2006 was not the best time to get started. I got wiped out pretty quickly after that. Bought my first house at the end of 2006. Learned that lesson early. Around 2008, basically got into foreclosures, was kind of, buying and selling for a lot of real estate investors. 2012, we started buying our own properties. 2015, we basically got into lending. I really saw that there was a significant need in the market for a lender that cared about the clients and cared about basically people making money rather than just kind of doing loans that they were willing to take back or doing loans that they were going to make money on and kind of forget about them after the fact. And kind of my priority has always been to really be there from start to finish and help be a support. So, and just like kind of as in general, we've done pretty significant amount of volume. That $750 million, that's, a lot of that is, loan volume, about 150 homes flipped. So close to $100 million in it, in, single family, multifamily, land, small apartments, mid-size. Biggest apartment complex we did was 88 units, and kind of looking to expand from that perspective. 2015, I kind of really went into lending. I kind of explained why earlier, and it's probably one of the best choices I've ever made. I've come to learn that I'm not really the guy that likes to be out in the field swinging a hammer. I like being behind a screen, talking to people all day and, running numbers and figuring out creative ways to structure a deal and get something done that, some people might have already given up on. And really my main interest is really helping make sure that you achieve your goals and you accomplish kind of what you want to accomplish in your career. Real estate, I mean, it has its ups and downs. Right now, we're definitely going through a pretty major up, which has its pluses and minuses. Inventory is obviously hard to find. That's something I can kind of touch in on as well in the presentation. I didn't really have a slide for it, but I've kind of done the bird dogging before. So, there's kind of multiple different strategies you can utilize. And then kind of at the end, definitely dive into any kind of more customized questions that you might want to go into and learn about or get my comments on. So there's kind of a variety of different loans. So I'll kind of start from the beginning, just for anyone not familiar. So this is kind of what I think are the main loan categories that exist out there. I mean, there might be a few more I don't have listed. Oh, I don't have land listed on here, but we don't do very much with land. But conventional and conforming is pretty much the bank loans. Fannie Mae, Freddie Mac, Wells Fargo jumbo loans, things like that. The stuff where the banks, conforming loans basically require you to show income. So that's, for the most part, you have to qualify with income, which is kind of the foundation of conforming. So I just kind of have that at the top because, that is the most common type of loan out there. And Optimus Capital doesn't offer them, but I do have some really good references if anyone ever needs something for owner occupied or anything of that. The next kind of batch of loans is the ones that we are pretty involved in. So bridge loans is basically a loan where it's short-term loan, right? So you can use a bridge loan if you need money out of a property before, because you need that money to buy another property. People do bridge loans because they need quick cash to fix something up. They do bridge loans because they want to fix up their property before selling it. There's really a different variety of reasons people like to utilize bridge loans, and there's a big use for them. The interest rates are obviously a little higher than most conventional loans. They are short-term loans, but they're not meant to be permanent. So the main foundation behind a bridge loan is that it's a short-term loan that you get for 12 months, 24, 18, 24. There's even 3-year bridge loans. But I would say anyone that's looking for a bridge loan that long, you need to rethink your strategy because there's no reason you should be paying 9 or 10% interest on a loan for that long. The only time really bridge loans make sense is when you are planning to do something with the property or with the money that you're borrowing to increase the value of the property in order to either sell it or refinance it into a shorter, kind of or lower cost long-term debt. Fix and flip loans. So fix and flip loan is a variety of a bridge loan. So it's basically, the main difference is with the standard bridge loan, the lender is going to look at the value of the property as it is. With a fix and flip loan, we're going to look at the property after it's repaired. So, most of the time, all of our fix and flip products are going to include 100% of the renovation costs. So, say if you buy a property that needs $50,000 in rehab, we'll give you, the money for the purchase plus the money for the rehab. So it's all done in reimbursements. But, basically with a fix and flip loan, we care more about the value after the property is repaired than the value as it stands. Because, again, kind of the whole strategy is to go in and, do value add to the property and then, and then have something that is worth more than when you started. New construction loans, I think those are pretty self-explanatory, but, it's kind of ground up. So where you have a raw piece of land, you get plans approved, you get a permit. I don't recommend new construction loans until, basically you're ready for permit. A lot of people, buy a piece of land and they're like, oh, I want a construction loan. I'm like, well, do you have plans done? Well, I just started drawing them. You might be 6 or 8 months away from building, so you shouldn't start paying. You shouldn't be paying closing costs and fees and interest on construction money if you're that far away. So typically, you want to prep for a new construction loan maybe a month before you have plans approved. Or you expect to have plans approved. They do take a little longer because there's some feasibility studies involved, but we're still getting those turned around pretty quickly. The leverage also on each one of these, I'll kind of give you the leverage. So on bridge, typical leverage is 70 to 80% loan to value because there's no value add component to it. On fix and flip, you're looking at we'll, depending on the credit score, we'll do up to 90% of the purchase price, 100% rehab. Typically 80 to 90% on purchase money and 100% of rehab is pretty common. So you'll see that a lot. And, I try to hit that 90% as often as possible. New construction it's actually, so how we underwrite new construction loans is we're going to look at more on the loan to cost rather than the loan to value. Because basically new construction loans are considered a much riskier type of loan. So, kind of the reasoning behind it is, since it's riskier, you're going to have more skin in the game because, the more skin in the game a borrower has, the less likely that, they're going to default or walk away from the loan. Non-conforming rental. So these are actually, I would say right now, our most common loan. We're doing them across the country. Basically, it's a rental loan that is done based on the income of the property rather than the income of the person borrowing. So there still is going to be, an underwrite on liquidity and ability to pay and things like that, but there's no need for tax returns. So the biggest difference between a bank rental loan and say, a non-conforming bank rental loan is the bank is going to typically look at your global income. So they're going to want to make sure that you have enough income every year to support the payment of the house that you're refinancing or financing. where we're looking at, the main factors are going to be, what is your, what's the value? So, there's loan to value parameters. What's the debt service ratio? So of the property, which basically formula is pretty easy. It's, what's the income of the property, rental income, usually we're going to look at the appraisal market rent. And it has to be within range of what, the actual rent is. And then the expenses are taxes, insurance, and HOA fees, if there are any, and then mortgage payment. So, between those, as long as you're positive cash flow, I can do negative cash flow properties as well. California, it's pretty hard to have a positive cash flow at a higher LTV, but if you don't have the cash flow or you're under, break even, you're capped at like 65% loan to value. The reason people do that is, some people run Airbnbs and stuff, so they might, not necessarily care that their market rent isn't going to cash flow. But from a lender's perspective, Airbnbs can kind of get closed down or shut down or, removed anytime. So, that's where you're really going to get hit on that loan of value by doing that. The ways to kind of work around it is, again, if you kind of have a friendly tenant, it's no one's going to call the tenant to confirm, if that makes sense. So the rental loans, the interest rates are going to range, typically anywhere from, I think our rate sheet right now starts at 4.25, goes up to about 6%. And again, that's going to depend on credit, cash flow ratios, and loan to value. Commercial and multifamily. So I don't do very much commercial. We do a fair bit of multifamily. So basically anything over 4 units, so 5 units and up, is going to be considered a commercial multifamily loan rather than a residential. Up to 6 units, you can kind of get away with some residential products. Some of our investors will go up to 8 units, but kind of the more units you go up to, the tougher the underwriting gets. Because then you're kind of in a different realm. So, kind of multifamily loans are typically going to be lower loan to value. Once you cross the $1 million loan amount, banks will work with you. Anything under $1 million, like 5 units or more under $1 million, there's a very, very limited amount of pool of investors and lenders that will work with those properties. So anyone that's tried that, you could have probably, found that out the hard way. But you're going to get a lot of no's. Typically minimum loan amounts, $1 million for multifamily for anything kind of for any commercial lenders, and residential lenders can't go over 4 units. So, you're kind of in that mid range. So that, I do have solutions for, whether it's, fix and flip or bridge or long-term. But just kind of keep in mind it is a little more expensive than a residential loan or a commercial loan over $1 million would be. And then unsecured, so we don't offer these, but
Can I follow up real quick on the commercial multifamily? If you can clarify, you mentioned that if you're 5 or 6 units up to 8, you might get away with residential, but it's closer to commercial. Are you talking about the underwrite? You might get away with the way it's underwritten?
Yeah, exactly. So you could get away with a residential underwrite. But it's going to be like a paper, so you got to have really good credit. It's kind of like a conventional loan almost, but it'll go up to 8 units.
It's still not non-conforming, right? So it's not. It's not
correct. No tax returns. No tax returns needed.
Mm-hmm.
Yeah. So nothing I do requires tax returns.
Right.
And then unsecured, that's like credit lines, credit cards, there's kind of a lot of different options out there that, I've kind of helped people set up. We don't necessarily offer anything like that, but, there's really, there's certain banks that'll do line of credits, with COVID, that a lot of those got shut down. But, you typically, to get anything unsecured or business credit, you got to have pretty phenomenal credit. And good existing credit, which you want to make sure you build up. And then that kind of opens the door up to kind of more options on, the unsecured side where, basically you can pull out a line of credit, convert it into down payment money, and then, essentially through that, pretty much have, no down payment, potentially, by leveraging those strategies, get into properties with no down payment. So, the next thing I kind of want to talk about is what does an underwriter typically look at? So a lot of people, I think, have, the wrong understanding of, what is being looked at and why. So I'm happy to kind of, dive in and answer any additional questions on that, if someone wants to, bring them up. But most people think that, oh, it's just a hard money loan. Why can't you just loan against the property? And my answer on that is yes, I'd love to, but you're at 50% loan to value. So if you want to get above that, now we have to start looking at what else are you bringing to the table. Maybe 60%, but kind of it's a loan's a loan, and especially when the market is as inflated as it currently is. It seems to be going strong, but it's kind of, no one has a crystal ball, right? You got to just from a lender's perspective, you always have to have kind of a conservative mindset. And I would say right now, with prices going up, it's actually making lenders pull back a little bit, being more careful and kind of making sure that they're in the right markets, that the borrowers are qualified, that if the market does dip, that they're able to make the payments, things like that. But I'd say the biggest thing that we look for, like whenever we start with someone new, is like, what is your experience? So kind of, what's your background? What have you done? There's like an institutional definition of experience, and I'd like to share that. It's basically how many, and it's a very specific definition. So a lot of times I'll ask that question. If you're like, oh, I've done 50 deals in the past. Oh, okay. Or I've done hundreds, or I've built subdivisions. So unfortunately, there is a very, very specific definition, and it's how many homes have you purchased in the last 36 months that you sold in the last 24 months. So if anyone's taking notes, that's the institutional definition of it. How many homes have you bought in the last 36 months and then sold in the last 24 months? Kind of, instead of sold, you can also put refinanced into long-term debt. So that'll give a credit also. And it basically works like a point system. So, every sale is a point, a refinance that qualifies as a point, and the refinance to qualify, basically you would have had to bought the property with a hard money loan, or a non-conforming loan, and refinanced it into a long-term 30-year loan, or whatever, 5-year or 30-year. So that's kind of the official definition of it. Next thing is credit profile. What's your FICO score? So someone with 720 FICO is going to get a better loan than someone with a 680. Someone with a 680 is going to get better than a 600. What's the low? I've done a loan with a 490 credit score, right? But you're not going to get the leverage or the terms or the rate, anywhere close to someone that has a 750 credit. So even though, kind of, it's a wide spectrum of who we can work with, obviously the better credit profile you have, the better off you're going to be. And forbearance is a big issue. So I know a lot of people got kind of, happy that they didn't have to make payments on certain loans with the banks, but now it's coming back, and you can't refinance until those are done. You can't purchase until those are cleared. Basically, a lot of people that kind of put themselves in that position ended up in a little bit of a tough spot. We come across it often, and anything in forbearance, we're basically not allowed to touch the borrower. So you do just kind of want to be careful with that. A credit profile, the best way to keep it good is, have 3 to 5 credit cards, never keep them above a 25% balance. So if your credit limit is $10,000 on a card, never put it above 2,500, go use a different card, or pay it off before your statement date. So your statement, basically the statement date is when it reports to the credit bureaus. So you just want to make sure that, any credit that you have, also it'll save you a lot of interest, because if you pay it off, say, 3 or 4 days before your statement date, you won't get charged interest on that balance. Also, it's going to keep your credit profile looking good, because, you'll have your balances paid down prior to them reporting to the credit agency. So that's just kind of something to kind of keep in mind. Assets and liquidity. So, there are circumstances where we're not going to look at that, but kind of, if there's ever an exception needed, or something's tight, or your loan to value is coming in low, or we're going above a certain loan amount, it's going to be required. So a lot of times, kind of the things that we'd want to see is, do you have money for the down payment? Do you have money to do the rehab? Do you have money for the payments? Just kind of common sense things that a lot of people, for some reason, don't think about. but if you can't show any money for your payments, how are you going to make them? So, I mean, it's, I like to say it's easy, but there are workarounds. So if you have experience, or even if you don't have experience but you have excellent credit, I mean, I can do loans with no bank statements, no income, no documentation of any kind. Stated income, stated asset, basically. But if there are any any issues from that perspective, then potentially you're going to need to show bank statements and ability to close, as well as ability to maintain the property to get your project done. So here's kind of the, I call it the Flex Bridge, but basically kind of our bridge program, kind of what it looks like, just so you kind of have an understanding of kind of the limitations of it. So, we kind of have, there's a standard bridge and then there's a pro bridge. So basically it's, whether, depending on how much experience, based on the definition I described earlier, you have, it could kind of, determine or change some of these dynamics. But for the most part, even for a brand new borrower that has zero experience, never done a flip before, as long as you have 720 credit, we can go 90% of the purchase price and 100% of the rehab. If you guys work with wholesalers, or, if you are a wholesaler here, we will cover the wholesale fee, typically up to 10%. So we would just add the wholesale fee into the purchase price. I might give you guys some kind of creative ideas on how to make that 90% 100%, but I didn't mention it. So, for kind of our standard bridge, there's no experience necessary. Cash out refinances. So we do a lot of these people that, might be done with a project, but it hasn't sold yet, or maybe, it took longer to complete. Say the contractor walked out on you, you have to restart the kind of, your loan is due that you had originally with a hard money lender, or private lender that needs their money back for whatever reason. We do have kind of mid-construction loans as well as completed loans, and those are going to be on a bridge 12 or 24 months. They're all primarily stated income, stated assets, so we're not verifying any income. Close of escrow, I've closed in 3 days, so don't hold me to that 7-day window. But what I found is, working with someone new typically does take a little bit more time. So, I always recommend writing the contract at 14 days, even though we're always going to try to close faster than that. 12 or 24 months loans available. Those states, we're actually in a lot more states. If you have any specific ones, let me know. I can tell you what we can do there. But, we've probably done a loan in 40 states out of the 52. So, pretty much can cover a very wide range of territory. And it sounded like in this group, you had a few out-of-state investors. So, we're, just closed a bunch of loans in Cincinnati, a portfolio. We do a lot in Texas, a bunch in Florida. So, kind of, I like to cover the California, Texas, Florida, but we are pretty flexible all around. So up to $1 million, we can go typically without a full appraisal. So we'll need an inspection, but it'll be more of a, like an inspector that comes out, takes photos, and then we'll be able to establish the valuation outside of that, or a BPO. If we go over $1 million, that will trigger an appraisal requirement because, kind of the higher dollar loans, they're just kind of riskier, and, just got to kind of have that extra level of comfort from the financing. We've done a lot of refinances mid-construction. So basically either for fix and flip, some heavy flips just kind of go over budget over time, and you need that extra money to pull out that you've already put in, or even new construction. So someone building a brand new house, halfway through they get drywall in, I can usually come in and cash them out and then give them the rest of the money to finish the project. So a lot of our clients are builders that, basically they do that. They build with cash up to drywall, and then they do the takeout loan to finish it. Because then, it saves them interest because they don't have a loan out as long. And, we're okay with those. We can do foreign nationals. We can do self-directed IRAs. It's going to be a little bit lower loan of value, but, that is on the table. So I just kind of keep that in mind. And yeah, so trusts, LLCs, foreign nationals, self-directed IRAs, you can set up an LLC for those. It's kind of the way I usually see those done. So, I think I heard someone talking about IRAs in here. Was it Mike? Yeah, so Mike was mentioning that up. So that's that. Then this is kind of like the Rehabber Pro. So this is basically the Pro where, and the rates are actually a little bit lower than those right now in California. But basically our Pro program is if you've done at least 5 flips in the last 2 years. So that's that same definition. 36, bought in the last 36 and sold in the last 24. So last 2 years, so you get 100% of the construction soft costs and hard costs, 90% financing. The interest rates are pretty darn good. Obviously, the more down payment you put, the better the rate you're going to get. At 90%, you're right around that 8.5, 8.75. The better the interest rate, the lower the rate's going to be also. The way we evaluate those is loan to after repair value is kind of more important than the as is value. So we're going to look, basically what's the house going to be worth after you're done, and the total loan amount can't exceed 75% of that amount if we're financing the renovation, and 70% if we're not financing it. So if you just give us a scope of work, but you're going to do it all yourself, basically you're at 70%, which, if you're not hitting those numbers, you probably shouldn't be doing that deal because, there's probably not enough profit in it to make sense to do it anyways. On these, so we don't require appraisal, so we can close in 5 days, move super fast, as long as title, escrow, and insurance all cooperate. Those are usually the biggest missing links. We send our request the first day, but we don't get paperwork back till the 5th day. I mean, guess it's going to take time to review and establish and kind of dig into that. Another thing so we really try to add value to everyone we work with. So we actually partnered up with Home Depot just with our kind of construction volume that we do. We've actually gotten them to allow our clients on the capital side to work with as well. So it's the Home Depot renovation program. Reach out to me, and I can send you kind of instructions on how to set it up, after the meet. But basically it's savings anywhere from 10 to 25% off when you shop at Home Depot. And what it is, it's a little phone app. It takes a second. You generate a coupon. You just type in, basically you have to register the address in our system. And then, once I plug it in, it takes a couple of days to populate. You put in the address into your Home Depot app. It's not the one that you can download. There's a special link for it. You put in the address, it gives you a coupon, you just scan it, and it gives you an automatic discount at the register. So you don't have to go through ProDesk. You don't have to deal with, you can even go through self-checkout and it'll work. So it's super, super useful just kind of for those quick, everyday purchases that you might do to rehab your properties. But it also saves, thousands, if not tens of, I have clients that spend, 200,000-300,000 in construction. I mean, they're saving 20,000-30,000 a year just by using our coupons. So, it does go a long way, and that's just kind of a little, benefit that I've been able to source to help our clients. I have some travel rewards too. So, like hotel discounts and programs, if you ever wanted to make an account, it's anywhere 10-20% off, but, it all kind of, those 10-20% offs add up depending on your budgets. So,
yeah, they can add up 10% here, 10% there.
Yeah.
And you have close to half. The Home Depot program, is that available only for a property that's financed with Optimus Capital?
So, that's kind of the theory behind it, but, I don't hold you to it. So, as long as we have an address that we register,
So you have to register the address on your end.
Yeah.
Okay.
So usually like every loan that we do, we automatically register the addresses. If there's one that, you guys want to plug in and start utilizing or testing the program, more than happy to collaborate and, put in an address that you can use, for the time being. So there's workarounds, it's, there's no verifications, but, happy to kind of add that as a resource to the group. And, just a little benefit for Sergi for being a nice guy.
Awesome.
But, that's pretty much it for, for my show. I don't know if you guys want to kind of do a little Q&A or just kind of ask, really anything. I mean, I kind of went through a lot of that pretty quickly, and I just covered the lending side for the most part. If there's any, I don't know how much time we have, but if there's any topics, Sergi, you want me to talk about, happy to just kind of free flow.
Yeah, we're good on time. I think let's start off with any questions anyone might have. Maybe first specific to what you talked about, and then we can also venture out into maybe other non-lending topics as well. So I'd give it over to the group, and you guys feel free to ask questions.
So I have a question with LLCs. I heard you talking about some of the loans that are available for them, but you just may get a lower LTV. So LLCs with your company, what are you looking at for an average LTV?
So LLCs are fine. It's just if you're doing a self-directed LLC, because there's no personal guarantees allowed, that's where the loan to value gets a little lower, so you're more in like the 70 to 80% range. But 90% of our business is all done to LLCs and corporations. So we'll do the standard, 90% of purchase, 100% rehab for LLCs. That's not a problem. It just depends on who the signer is and what the credit score for the signer is. That's going to be the main driver.
Okay.
Yeah, LLC is not a problem at all. We just treat you like a person.
Just to follow up on the LLC self-directed, do you require that we keep additional funds in our account? Like you said, minimum is 70% loan to value, but then do you require?
So we might do we might be able to do 75%. Just really depends where and kind of who the signer is. So for those, you do need to have enough money for reserves. So you'll typically need 6 months of reserves for payments and for, in case the tenant moves out. The tricky part with self-directed IRAs is you're not allowed to contribute personal funds at all towards the project. And if you do, you basically trigger a lot of tax consequences. So that's the big issue to where, it makes it a little harder to function as a real estate investor with that, but I know a lot of people do it, and some do it very successfully. But you'll definitely need to keep some reserves in the account and show the ability. We can even do long-term loans with those, but if you do a bridge loan, you still need an exit strategy, whether it's refinance into long-term or or sell the property. Those are going to be the two options as well.
How hard is that reserves? Like, what if I'm 6K short on the reserves?
I mean, you're going to want to show at least 6 months of payments after all the money for the acquisition, plus if there's renovation. I'd say you want at least 6 months on top of that. I mean, if you like to actually do real estate investing with a self-directed LLC, I mean, I'd say you want to be pretty well capitalized in it. You don't want to tap it out because, again, if something like, say, a roof leaks and you have to replace the roof, and you do it out of your personal money, you just triggered basically all of your LLC or all your self-directed holdings are now triggered by to become taxable income. So if you've been saving up into it to get a write-off, you basically just destroyed your whole, however many years it took. So, I'd say it's even just for yourself to be safe. You want to make sure you have reserves. You don't want to do any transactions in a self-directed LLC where you're not going to have, $50,000 to $100,000 left in the account to kind of just sit there and, as just in case money, in my opinion. But to each their own.
Thank you. That's very helpful. Thank you.
Max, are you typically charging points on any of these loan programs?
Yeah, so we have points. We have, we'll have processing fee and underwriting fee. We work pretty much on the level of institutional lenders. The points are going to vary based on volume. So the more volume we do, the lower they get. Usually I start at 2.5. Bigger loans we can go down to 2, and then as we do more and more business, that number could go down. Depending on, kind of how many transactions we're doing, the size of the loans, bigger loans, we're going to do a little bit of a discount. and then just kind of, really volume based more than anything.
I got a quick follow-up to the commercial multifamily underwriting. Can you maybe share a little more on the difference between how would a commercial property be underwritten versus a residential? And let's say we're talking about like a residential fourplex or a 12-unit apartment or larger. Or maybe just what are the major differences to know of?
So the biggest, so up to 4 units, it's considered residential, which what's interesting is anything over 2 units in construction is considered commercial. But in lending, anything over 4 units is considered commercial, in construction. So if you're building a triplex, you have to build to commercial spec. If you build a duplex, it's residential spec, which never really made sense to me. In my mind, it was always, 4 units is residential, because I had the the lender background. And then when we started doing kind of development and stuff, I was doing, it was like, okay, so it's better to stick to duplexes, because as soon as you do a triplex or fourplex, now you got to have commercial specs on, the construction. So that was kind of eye-opening for me. In terms of the commercial, like what changes. So, I mean, I still have a hard time wrapping my head around why necessarily it's such a big difference. But I mean, like on a 4-unit, 30-year loan, I can get a 4.5% rate, where on a 5-unit, that same loan is going to end up being like a 6.5%, 7% rate, which, it's pretty ridiculous, I think, kind of how much it changes, or how drastic it is. Like I said, there's some new programs out now that, they'll go up to 8 units with the same residential guidelines, but they're like super strict. I mean, basically like bank style. They're going to want to see, everything. And I mean, they'll lend, I mean, it closes, but it's just a lot more difficult to close. The biggest things you're going to need is you're always going to need to show liquidity, and strong liquidity, strong financials, typically experience. If you're doing it out of state, it's going to be, okay, so how are you going to be able to manage this? What's your plan? You got to really dive into a lot more details. Other differences, I mean, it's really just the rate. I mean, they get done. It's just the interest rate starts getting a little hairier. Once you go over $1 million, a lot more banks open up. So, kind of, Fannie Mae, you can do Fannie Mae loans. I think their minimum might be 2 million. But, they have like a small cap at $1 million and up. But, anything under $1 million multifamily over 4 units is going to be just expected to be more expensive. And, versus a 30-day close of escrow, or, 20-day close of escrow, you're looking at like a 60. Because, commercial appraisals take longer. That's the biggest thing, which, you're doing a $600,000 property and you got to pay $5,000 for an appraisal. It kind of, it's like 1% fee for appraisal. Mm-hmm. So, yeah, I've kind of learned it. I kind of shy away from it, but a good opportunity is a good opportunity. So, I can see why people go after them.
All right. Everyone's thinking.
Other questions?
Any questions? Yeah, either one. Sometimes you're just trying to. There's so many questions. You're trying to figure out what exactly what would be the most relevant to ask. It doesn't have to be on lending necessarily. Let me throw this out. What's your thought? So if someone's looking to invest in small multi, right? So something over 4 units, so it'd be commercial lending, but it's not large enough maybe to be over $1 million. It sounds like the terms for financing on those properties aren't going to be as favorable, and I'm assuming that the pricing on those will be will show that as well, and there may be less competition as well compared to maybe some of the larger deals that have larger financing or better financing. Is that true, or maybe there's just even less people or less competition at the higher price levels as well, just because it's higher, more money? Like, what do you see, or does that question make sense?
Absolutely. So
Mhm.
I think definitely it's kind of that mid-tier multifamily. It's a very good niche to exploit, I guess that's the right word, because you do have a lot less competition. Because number one, financing is harder to get, but also number two, it's like you're too big for the mom and pops, but too small for the institutions.
Mhm.
Once you get into the institutional range, so once you're in like $5 million and up properties, and it's actually gets more competitive. So the price cap, or the cap rates actually go down once you start getting into those larger transactions. So kind of I'd say anywhere from the 5 to 20, maybe 30 units range. You're going to have a lot less competition. Once you start going above that number, now you're competing with bigger funds that, just they're flush with cash, especially right now, that, almost make it impossible to compete with. But yeah, small tier multifamily, yeah, it's more expensive, but at the same time, I mean, you can make more money because you have less competition.
With your company, what's a normal range for points?
So we're typically, somewhere or float around 2 points, plus or minus, depending on how difficult the transaction is and how much volume we're going to do, how big the transaction is, things like that. Like say on $100,000 loan, we're going to charge more than on a $1 million loan.
Okay.
That's just because it's the same amount of work. But yeah, I mean, kind of, if you're using a pro forma, I'd stick to like a 2% number for points.
What markets are you seeing, from maybe where you're lending, that may be good potentials for investors to look into, as far as returns go, or maybe potential growth? What are you seeing out there?
Let me pull up. I actually just got a growth chart. Let me open it and I'll share it on my share it on my screen. Let me find it. Share screen. Can you guys see the screen?
Yep.
All right, so these are basically the expected growth in markets across the country. So major markets are basically like major metro areas. Secondary markets are kind of close to major areas but smaller on the scale. So as you can see, Sacramento's number 3 on the list, so that's good. Naples and Sarasota are doing really good. Seattle surprisingly is doing good. But then I always think, I've always seen people do better in secondary markets because it's kind of more growth opportunity where you're not, kind of major markets are going to have bigger funds and bigger players in them typically. So like say Blackstone, they're only going to buy in major markets, and then they started buying in secondary markets. But, that's just after, they completely bought everything they could in the major markets. So, a lot of things like with kind of things going institutional in the real estate world more and more over the last decade. That's really who you're competing with is the hedge funds. And, it's kind of, to stay ahead of them, you kind of go into, the market, because they're looking at the same data that you're seeing right here. And, this is how they're determining which markets they're going to go into. So it's kind of like follow the money. But also, this kind of, if you want to take some notes or take a screenshot, these are kind of our target markets. At least, this is where I'm targeting most of our marketing and advertising right now to get new business, because it's kind of always safer to be doing loans where prices are going to grow versus where they're not going to grow.
What are your thoughts in terms of if there is a correction that comes in the near future, whenever that might be? What specifically may happen in these markets versus other more at-risk markets, and why? Like, what underlying maybe data or factors are there for why that may happen?
Yeah, so I think it's always going to be safer in kind of like a market that has more growth going into it, because it's going to take longer for it to cool down, if that makes sense.
Yeah, it's
Because
more
it's kind of
momentum.
like yeah, there's a curve. So when you have more momentum, I mean, they tend to fall harder. So when the correction does happen, you probably see a bigger move on the scale, percentage wise, because it went up more percentage wise. So when something goes up more, it goes down more, from kind of a percentage perspective. But it also gives you more time to react. So kind of the big things, the big indicators that I always look at, and anyone that's on MLS or any, I mean, this data is all accessible, but the housing price index, or the affordability index, basically, what percentage of people can afford the median sized home, as well as the days on market. So, kind of in 2006, 2007, I mean, days on market went from, 2-3 months of inventory up to, I think it was like 9 months of inventory, and the home prices were still going up. So, kind of that, watching that curve kind of gave me a few triggers to look out for. And basically it's, right now, that's why I'm not too concerned with, values now, even though they are kind of hitting new records and continue to outpace kind of what, job growth is. There's still no inventory on the market. So the problem you have, you got to start being careful when you see the days on market, or not even days on market, but the total inventory listed, going up compared to the amount of buyers. So, as soon as the buyers start disappearing and the inventory keeps being added, I would run as fast as you can, get out of everything that you're leveraged on, and just stay in dollars and wait for the correction.
What are you seeing on the lending side? There's an announcement from Fannie Mae saying that they're going to cut down the number of investment loans, and they're the only ones. So if Fannie Mae does that, does that mean you'll get more customers? And where are you getting your money from?
Yeah, I hope so. I'll take it all.
No.
Yeah, so all of our money, I mean, it's 90% institutional. I mean, I do have, we have our own fund that we can lend out of, and we work with a fairly large amount of private investors around the country, and kind of private funds. But I'd say the majority of it now is institutional money. So that's kind of why the guidelines have gotten very cookie cutter, and as long as it fits the box, it closes. There's no emotions involved. It's all based on it's based on numbers and facts, and the data that's presented. Everything's going computerized and automated, and that has its pluses and minuses. But for the most part, the well's not going to run dry anytime soon. There's more and more money going into our space to back these loans than there's ever been. And they're asking for more loans.
Does that include retirement funds?
Yeah, I mean, there's pension funds in it. There's retirement funds. There's insurance money. I mean, it's a wide range of institutional investors that are interested in kind of these security. They've become securities essentially. So I mean, what happens is these loans get bundled up and sold on Wall Street, in $250 to $500 million packages. And that's why the pricing on hard money's come down so much, where before, hard money used to be 3 points and 12%, where now, we're like, 2 points and 8.5% or 8%. It's never been this cheap. I'm even getting stuff in the 7s for kind of lower leverage and, good quality borrowers, where before, like say 2012, I mean, the cheapest you were going to find is 12%. So it's, it's definitely changed. But yeah, the money, I mean, Fannie Mae, kind of surprised that they're not loosening up, but at the same time, the harder they get, the more business we get. So I don't necessarily mind.
What's your thought about potential inflation, rising costs in construction? So let's say if someone's looking at investing into in general into real estate right now, right? Some people have been kind of sitting for a couple of years waiting for a crash to happen. Others have been investing. But there's an argument maybe they're risking something because once the crash happens, they might lose it all. And I'm just saying kind of in general all the different opinions. What's your what do you see? Or obviously no one has a crystal ball, but what's your kind of sense of what's happening in the market and what may happen, given seeing that everything's so gone up quite a bit in price, both real estate and all other commodities in general.
Yeah, I mean, it's kind of concerning with how crazy stuff's gone up. But when you compare it to how much money's been printed, I think it's all relative. I think the big reason that there's such a big crunch into real estate right now is, people are really losing faith in the dollar. I mean, there's been more dollars printed than in 1 year than there has been in the entire history of the country. So that, I mean, a lot of it's been distributed, a lot of it's been held back, some of it's been corrupt money that, went into the wrong pockets. But at the end of the day, it's still been leaching into the ecosystem. And, I mean, just creating some really heavy inflationary pressure, on everything, on construction costs, on labor, on, I don't know, it's kind of interesting. In terms of where it's going to go. I mean, I think that's really why real estate prices have accelerated so heavily, is because of the inflation. And we're not really seeing the value of homes rise. We're just seeing the value of the dollar fall, which, is perfect reason for inflation. And I think the numbers being reported are being underreported. I think there's a lot more inflation happening than anyone's talking about. And what that's going to do is cause a spike in interest rates sooner or later. So you just got to kind of ride it while it's good, but just kind of, try to get everything, I'd say, into a 30-year loan if you can, or a long-term loan, however long you can get, because I mean, they're hesitant, every time they raise interest rates, there's a big stock market correction, and then they lower it back to, they get scared.
They tested it and then take a step back.
Yeah, I mean, I think that's kind of how it is, but it's, it's kind of, I don't know. It's hard to say what happens next. I've been trying to figure that one out myself. I don't think we've ever had this kind of, this kind of a history happen before, or just in the history of the country. We've never kind of been through something like we were going through right now.
Mm-hmm.
But real estate's one of the best asset classes to have during inflation. So, it's definitely a good hedge. And, basically the value of your loan goes down, and, the equity in your property goes up. So it's, definitely being in real estate, I think, is the best thing to be in right now. It's just hard to predict how long it'll last, because a lot of the things are not in our control, right? Like, we can't control when they raise interest rates. So that could happen tomorrow. That could happen in a year. Could happen in 3 years. Could happen in 5. Like, we really don't know. So, at that point, it's kind of gambling. So you just got to be as educated of a gambler as possible, and just try to take calculated risks. And I would just say, people always want maximum leverage, but I always recommend against it. You're better off putting a little more money down and not having to worry about, a small dip eating away at all of your equity, and then basically, getting no money back after you close. I'd say it's better to be a wholesaler than it is to be an investor until you have that extra reserve to put a little extra down payment. Wholesalers a lot of times will make just as much money as the investors without having to take on the risk or the work. So there's, like, if you're good at finding properties, that's kind of, a lot of people try to buy everything they can, and I've just seen that end in catastrophe. So I kind of always try to advise against, getting too high leverage. I mean, we'll give it to you, but you're the one responsible for paying it back.
What's your outlook on the Sacramento market, relative to California and the nation?
I think we're the strongest market in California for sure. I mean, it was number one in the country for a little while. Very bullish on Sacramento. I think it's a great place to be, and we're in a good place at a good time for real estate. As long as you're involved in the market, either doing sales or wholesaling or buying and flipping, kind of it's definitely appreciating at record pace. I mean, I read something where there was like 132 offers on a property, that was listed, and I mean, I just find that incredible. But yeah, I mean, they're saying 20% growth, which for me that just seems unreal. But if you got assets in Sacramento, it's definitely you're in the right place. Yeah, I'm guessing there's no going to be small group breakups. We're already kind of a small group.
Yeah, the breakouts we do usually it's 2 to 3 people. So even with like 10 or 9 people, it's still a little tougher sometimes to get everyone involved. We can go into breakout groups. Oftentimes we only get instead of doing 2 rounds, we end up doing just 1 because we run out of time. So if you guys have before we go into breakout groups, again, I want to just give an opportunity for any other follow-up questions, or maybe you guys want to just you have some thoughts or questions totally not related to what we talked about today. Here, Jack, I hear you saying something.
Oh, I'm with other people. I was just chiming in. So what about like hard money loans in Vegas? Do you know, does your company go there, or is it more
Vegas?
In Vegas? Yeah.
Yeah, so we're not in Nevada right now. I don't get enough demand there to get the licensing set up. So we cover like 40 states, and Nevada ain't one. It's really weird. So Nevada, Arizona, and Oregon, which are all neighboring states to us, we don't do. But every other state, pretty much we do. But it seems the West Coast, and the reason we're in California is because I have full licensing in California since I've been here. But yeah, it's kind of weird. The West Coast has all these strict regulations, and like hard money lenders get like so scrutinized by regulators on the West Coast, but every other state in the country is pretty much, open game.
Yeah. Okay. And then you mentioned earlier that hard money lenders are usually now at 2% fee and about 8%. You said, is that on average, or is that what you guys are doing?
I mean, I'd say it depends on where you are and kind of who you are. Different markets will have different rates, but I'd say 2 points and 8 to 9% rate is pretty much the average right now.
Okay.
But there are factors that would affect that depending on down payment, credit score, and experience is kind of the 3 primary factors.
Okay.
I'm sorry, I forgot to ask, what is the term, the length of the term for 8 to 9%?
So bridge loans are 12, 18, or 24 months, and rental loans can be 5 years, 10 years, or 30 years fixed.
Do you, from the lending products that you talked about, do you offer all of the same products in all states or markets, or can it vary? So for example, let's say if someone's looking to do new construction in Florida, do you do that as well in Florida and every other state, or do you kind of select which certain products for certain markets?
No, pretty much the same product line across the country.
Mm-hmm.
And then the rates for those long-term loans, the years, what is the rate usually in California for those kinds? I understand what you said about rentals.
Yeah. So on the rental loans, we're starting at 4.25. That's kind of at like 60% loan to value. And then the higher loan to value you go and the lower credit you go, the higher the rates get. So kind of caps out at like the 6% range.
Okay.
They're still really good. I mean, it's
what term? How many years?
30 years fixed.
Mm-hmm.
And then we do, so a big portion of our business is portfolio loans. So anywhere from 5 to 50 properties that we can wrap into one loan, which saves a lot on closing costs when you put them all together.
Yeah. So I was going to ask if someone can get a conforming loan, so Fannie Freddie, right? For a higher LTV, why would someone go with a product like you're describing? And so it sounds like where it really makes sense is if someone has built up a portfolio and they want to have one loan wrap around a group of properties, and that frees up their ability to potentially purchase more properties with a conforming loan as well, right? Is that one of the situations, I guess?
So Fannie Freddie, I mean, I don't really see any of their loans being competition for us. It's
Mhm.
completely different products. So they're
Mhm.
going to look, number one, you can only have 10 loans that are going to be Fannie Freddie. So you're capped at 10. Each one of them has to be in your personal name. They're not going to lend to an LLC or a corporation or anything
Mhm.
like that. And I mean, I argue that, I mean, their rates on investment might be 3.5%. But to qualify for that, I mean, honestly, I haven't seen anyone qualify for them, especially anyone that's a real estate investor, because, you're usually writing a whole bunch of stuff off. Maybe for, if you're doing a couple of properties, I mean, I know people with, 10 loans and then they're capped. So a lot of my clients, they already have their 10 loan cap limit. So if you can get those, absolutely, there's absolutely no reason not to. But it's going to be very limiting on how big you can grow, as well as the qualification factors are much more difficult. I think they're cash out. You're probably limited at 70%. I think still for cash out refi investments, where we'll go up to 80. So it's really the loan to value difference, as well as just kind of the limitations from a lot of those perspectives. But yeah, I mean, if you qualify, I mean, I'll be the first one to tell you, it's a good loan. You can get the lower interest rate, but I found that very few people actually qualify for it.
Hey Max, I have a quick question.
Yeah.
So in purchasing a property, let's just say there's a potential ad for like an ADU. Do you guys fund the whole project, including the construction of the ADU?
Yeah, so we can finance the ADU build.
Okay. Awesome.
What are you seeing as far as like in the Sacramento area, for example? If you've seen what costs are involved for a single ADU, as far as construction and permitting involved in that.
I've seen a couple of different kind of products out there. There's a lot of prefab ADU products going in. People are like trying to convert like 40-foot trailers into ADUs and all kinds of wonky stuff. I mean, I'd say anywhere from $60,000 to $100,000 is probably the range, depending on how nice of one you want to get. I mean, they're even starting to sell them on Amazon. Just build one yourself in the backyard and put a render in it. But I'd say 60 to 100,000. I mean, construction costs have gone up. I mean, I'd say about 20% in the last year. So it's just kind of be aware of that. I mean, if you're going to do it, to code and permitted and build stick built, I mean, you're probably over 100,000. If you're doing anything decent. Construction costs, I mean, per square foot, unless you're going really cheap, I mean, I'd say you're at least $150 a square foot. And that's, for small square footage, that's probably not going to get you very far.
Yeah. Right. Anyone else? Or are we ready for breakout groups? All right. Let's see. So let's do breakouts. Oh, I have before we break out, and some people may not be able to stay to the end. We'll have Max's info. I'll send the email out to everyone who's on the call today, and also we'll have it up on with the video once we upload it. So if you want, Max, maybe shoot up that slide one more time right now while I'm finalizing the breakout groups, so that people can get in touch with you directly if they want to follow up.
Yes, I can. Or did you say we're gonna email out to everyone?
Yeah, yeah. I'll send an email out this week with everyone's contact
I can put
info.
my info. I'll put my info in chat.
Okay, let's do that. Yeah. And an email will go out with everyone's info so you guys can connect with each other. All right,
Guys, I can
Yeah.
add something to that also. You also put quite a bit on this bio on the text that was our invitation to the Zoom. And also that did have a link if we need to get a hold of Max. It did have a link to his calendar that we can book some time. Am I correct, Max?
Yeah, so if you go to optimuscapitalcorp.com/max, you
There it
can book
was.
a
That's
time
what it
directly.
was.
Yeah, so it'll I'll put that in chat also.
Max, that was a fantastic presentation. We'll be talking soon.
Oh, thank you, Mike.
All right, so we're ready to go into breakout groups. I will open up the rooms, and you guys.
Sergey, I do have to leave at like 7:30, so
Okay,
just kind of
sure.
Yeah, have about 10 minutes.
Okay.
So
I'll
help out a little bit. I'll be in your
definitely.
group.
Definitely.
Yes, good questions.
No, and I want to give everyone a chance to do more, one-on-one, one-on-two type of networking. So feel free to jump out, Max. I'll watch, and then I'll reorganize the groups again for those of us who stay. So this is just a chance to network, talk to each other, see what we're doing, any questions we have. So I'll open up the groups. You should see a pop-up, something pop up on your screen where you can join the room. You should see that now, and you guys can join.